When we're setting our macro strategy and thinking about the various scenarios that we're likely to encounter as we work through 2022, it's very difficult to really forecast at all, really, the aspects of the impact of ongoing sort of variances in the virus. This is because there's so much unknown. I think what we do know, though, as we go forward, our ability to cope is improving. The various sort of start-stop cycles within the economy sort of future-proofs us to some extent as we go forward. So our base case really is that when we focus on the macro side of things, we're expecting to see more of a rebalance between the demand for goods and demand for services. And as we move through 2022, that'll take off some of the pressure on inflation that we've seen, particularly in the developed economies and certainly emerging market economies. And the economy will still overall grow globally, particularly in the US, of course. And there are some patches of uncertainty, particularly around China. But more or less, as we go and head into the new year, we're looking at an overweight position in risk assets, equities, private equity, other risk assets. And we're, marginally optimistic, I would say. But you're right, there are uncertainties. There were two reports overnight, one out of South Africa and one out of Scotland in the United Kingdom, which suggests that Omicron is less lethal than Delta, but more contagious than Delta. So these are the types of issues that markets are going to have to deal with as we go forward.
Yeah, we've been talking about those reports as well, Mark, and I think you're right. There's probably one thing that we don't remember. We've had 2 years experience and 2 years worth of learnings from fighting and dealing with the coronavirus, which is it's got to be worth something, right, in terms of building up the capacity to manage the situation in the healthcare systems as well. Mark, asset classes, risk. Let's talk equities first. Consensus seems to be next year is going to be good, but maybe not great. We had a guest earlier on who was looking for, as far as U.S. equities were concerned, mid to high single-digit returns for next year. Is that about right, do you think, or are you less positive?
I think overall we're positive, but valuations are stretched. Return on equity and underlying businesses in the United States is still running at about 18% per annum. Anything above 16, we are positive. But I think, as your previous guest has indicated, coming off the back of an exceptional 2021, it's very difficult to see a significantly positive year for next year, again in double digits. So we're sort of looking at mid-single digits as well overall, but there's still a great deal of uncertainty. We've seen the dot plot start to be discussed in markets. I don't think markets believe that the terminal rate that the Fed's going to exit at is at 2.5, which is what the dot plot is telling us. I think the market is expecting something more around 1.5 at the short end. So these types of uncertainties will work their way through. What we do know is in the equity market in the US and globally, there are some very good opportunities to pick up high-yielding stocks in high-quality companies. And I think we're going to continue to see investors rotate through the market. We've seen some flirtation with value stocks through the course, particularly the first quarter of this year and the end of last year. I think we're going to see that rotation continue through the market and the disaffection, of course, at different times with some of the higher growth names.